How impactful are these strikes? We're talking about a couple 100,000 workers here in the U.S. economy. If you want to include also the potential of another strike at Kaiser Permanente.
They're immensely impactful for workers. The increase in worker activism, the increase in worker organizing, and certainly the increase in strike activity has shown that workers are going to fight to increase their investment and employers' investment in them. So I think it's meaningful for workers around the country. I don't think it has really significant wide scale economic effects, national economic effects. It's not going to, for example, shave the GDP in any meaningful way. But I think it does demonstrate that workers are quite angry and they want more from their employers. They want a fairer share of employers' profits. Employers have been doing quite well over the last decade. So I think in that way, it is a meaningful action for working people in the United States.
So, Seth, it's pretty interesting. You say it's not going to hit GDP in a quote unquote meaningful way. Jimmy, I'm going to come over to you. You came to us about 10 days ago with some data that the UAW strike at all of the big three, if it goes on, could hit GDP as much as a tenth of a percent per week. Are you still sticking with that estimate, or does it have the potential to even have broader ranging impact in your mind?
I think it's sort of like the government shutdown, in which it can hit GDP, but the expectation is that on the other side of the strike or the other side of a government shutdown, that you'll get a bounce back, and on net it won't make much difference. I think longer term, what this tells me is that we have a really tight labor market right now, and in some cases, as with the UAW or what we saw with the Hollywood writer strike, there was a concern about technological change. But I don't think fundamentally the long-term trend of de-unionization is going to change. I don't think that's what these strikes mean. Again, I think they reflect a tight labor market. And I would guess the percentage of American workers covered by unions 10 years from now is going to be a smaller number than it is today.
All right, so Seth, I want to come back over to you. Let's talk about the U.S. credit rating and the risk to that. So about 10 days ago, Moody's issued a warning that if there was a shutdown, the U.S. credit rating could be downgraded. That certainly didn't happen, at least not now. A temporary decision was made to push that back down to November. But Moody's also cited intensifying political polarization. So is House Speaker McCarthy being moved out of the House Speaker role? Does that count, you think, in Moody's mind? Are we at risk of a credit downgrade?
Well, anytime you have the kind of chaos that we're seeing in Washington, it roils markets, it threatens the credit rating. Mostly because there's real concern that we will not be able to get to any kind of a meaningful resolution. That's what the concern about polarization is about. The politics is about the art of the possible. What we're seeing in Washington right now is really literally impossible. You can't govern without a speaker. And there's a lot of risk to our politics as well as to our economy that we just simply will not be able to make the kinds of decisions we need to make in order to run the government and run the country. So I'm not worried about it in the near term, but if it's the kind of thing that persists, and if we see repeated government shutdowns, if we see threats to the debt limit after the deal expires in a year or two, I think that is going to be a meaningful risk to the credit rating of the United States.
So, Jimmy, same question for you. Should we worry about the U.S. credit rating right now, AAA, the highest level?
Well, again, there's a difference between the debt ceiling debate, which is a huge risk, and the government shutdown, which I don't think fundamentally is a real risk. Now, listen, I think Republicans, at least some Republicans, maybe not many, would say that Moody's should be encouraged by this, because that means they're worried about spending and they're worried about the rising debt and long-term big structural deficits. I'm not sure I buy that case, because this is not about entitlement reform. It's about these kind of very harsh discretionary spending cuts. But some Republicans might say that, though I don't think Moody's at this point is listening to that argument.